Hello everyone and welcome back to a stock deep dive. And today we are having to look to see if Lyft is worth adding to the portfolio. So basically, I believe that Lyft is living in Uber's shadow, but it's got lately it's got a lot of news on the stock. So we're going to have a deep dive into that. Have a look at what the stock is about. Is the stock actually good? And what does the actual company do, if you don't know already what Lyft does? Now, of course, as always, this video is for educational purposes only. I'm not a financial expert or advisor, so this isn't financial advice, and you should always do your own research before making any investment decisions. So, what is Lyft? Well, Lyft is a US-based ride mobility platform or ride sharing, micromobility in some markets, that operates primarily in the United States and Canada. It's best understood as a two-sided marketplace connecting riders and drivers, asset light versus owning a fleet. So, as we've already mentioned, it's a United States based. It's in ride sharing industry like Uber, but Uber does Eats as well. Market cap at 5.3 billion. IPO at 2019 with a number of employees about roughly 2,900. It doesn't do any dividends whatsoever. But as you can see though, in the last month it's minus nearly 22%. 6 months 14.25%, and year to date it's actually down nearly 30%, and in the 5 years it's actually down 75%, or all-time 84%. So this company went public in 2019 and has, as we mentioned, the market cap of $5.3 billion. But as we mentioned, it does not own any cars. So instead, it connects riders with independent drivers, then takes a cut of each ride. So let's get into how it makes its money. So as Lyft makes its money. So Lyft operates, as we've mentioned, an asset-light, two-sided marketplace that connects riders with independent drivers. As we've mentioned, Lyft does not own any vehicles and it makes a cut or taking a percentage of each ride. So the basic flow, so in basic terms, I've put down. So for example, me, I request a trip and I pay the fare. Then the driver completes the ride and earns most of that fare, and then Lyft takes a platform fee. So it's a take rate from what they get, basically. So because Lyft doesn't actually own vehicles, the success depends on demand, pricing discipline, and cost control rather than capital-heavy investments. So this is the revenue data that I found. So revenue grew to 6.3 billion with a strong long-term CAGR, which at the minute is 3 years is 16%, 5 years is at 22%, and 10 years at 34%. As we have noticed though, COVID did cause a temporary dip followed by a full recovery. Growth confirms durable ride-hailing demand. Revenue growth does not automatically mean the business is profitable for Lyft though. Please remember that. So, as you can see, this tells us demand for ride-hailing and sharing was delayed but not destroyed due to COVID. That said, revenue growth alone does not automatically mean Lyft is profitable, which is why we need to go a little deeper. So gross bookings. This is one of the most important charts in the entire analysis for Lyft. Gross bookings represent the total value of rides taken on the platform. Before paying drivers in 2024, Lyft grew gross bookings to roughly 16 billion. That's up 16.8 year over year. We also see consistent quarterly growth since 2022, which shows rising demand and platform usage. Gross bookings are the foundation that drive the cash revenue, margins, and eventually free cash flow. So the take rate and monetization. As we can see, Lyft take rate is roughly between 30% of gross bookings, meaning the company keeps about $30 for every $100 spent on the rides, before operating costs, of course. The take rate flexible pricing power, incentive discipline, and trip mix, including high value rides like airport and peak demand periods. Because gross bookings are so large, even small improvements in take rate can make a meaningful impact on long-term profitability. So the riders, the rides, and the driver supply. So as you can see, we've got a chart right in front of us which shows the users between 2016 to 2025. Now, as you can see, the active user base has grown steadily over the long term, rising from the low digit millions in 2016 to the mid 20 million range by 2025. There was a sharp decline in 2022 due to, we already know, COVID, but since then Lyft has fully recovered and surpassed pre-pandemic levels. This rebound highlights the durability of the ride demand and Lyft's ability to re-engage users as travel and commuting normalized. So the Lyft's ARPU. So the user growth is important, but how does it make its money from the riders and the rides? Well, Lyft's average revenue per active rider reached $55.85 in 2024, continuing a long-term upward trend since 2018. ARPU has risen materially, driven by a higher ride frequency, better pricing, and a shift towards higher value trips. Even though ARPU dipped slightly in 2023, it rebounded in 2024, showing Lyft can grow revenue without relying solely on adding new users. Profitability. So when we look at the profitability, GAAP earnings for Lyft have historically been volatile and often negative. That's mainly due to stock-based compensation and one-time items. The adjusted EBITDA gives a clearer picture of the core operations. In 2025, the adjusted increased to about 528 million, up from roughly 382 million in 2024, with margins improving as well. Meanwhile, GAAP net income jumped sharply in 2025, but that was largely due to one-time tax benefit, not underlying operations, and this is why the adjusted EBITDA is better operating metric. So, as you can see, I have got the full 2025-2024 data, which, as you can see, in 2025, 528.8 million, where in 2024 was 382. The margin, as you can see, 2025 was 2.9%, where in 2024 it was 2.4%, so it's growing. And of course, the net income was way better, but it's, of course, as we see, the one-time tax benefit. So we are now going to cover free cash flow. I have covered this chart, this slide, many a times in the stock deep dives. You can happily pause it and read over if you do not know what free cash flow is and why it's important. So here is a story that really changes. So over the years, we have seen Lyft burning so much cash, but it's turned positive lately, which is a good thing, reaching 1.1 billion in the most recent year. This confirmed Lyft's shift towards cost discipline and operating efficiency is translating into real cash generation. So consistently burning cash after its IPO was not a good thing, but as you see, it's experienced a sharp cash outflow in 2020 due to the COVID downturn. But since then, we can see it's improved, which is a good thing. And for me, you need a company like Lyft generating free cash flow because that shows then it can turn from burning cash into profitability. And especially when ride sharing is going to fluctuate in terms of demand, you want to make sure that cash is there on the sidelines to cover what happens. So why free cash flow matters more than growth at all costs? Well, in today's market, investors care far more about self-funded, cash-generating business. Growth without cash is just simply too much of a high risk. Lyft has transitioned from cash burn to consistent positive free cash flows, driven by lower incentives and operating leverage. The adjusted EBITDA shows operating performance, but free cash flow shows the actual money the company can use, and Lyft is now converting that into real cash, which is really good indeed. Shareholder returns. So as we mentioned already, it does not do dividends. But instead of dividends, Lyft returns capital to shareholders through sharebacks. Buybacks reduce the number of shares outstanding and increase each remaining shareholder ownership of the business, improving per share metrics over time. Now, of course, we have seen a way increase from the time it released its IPO to about 2024, 2025. But last year, the full year, they actually announced that they were done a buyback. So as you can see, they brought shares down. So it was just over the 400 million mark. It's now on the 400.9 million mark, which is good. So that makes sure that you get to return of ownership per share. So basically, that helps reduce. It helps return equity basically. So instead of getting dividends money in, it actually makes your shares worth a little bit more. Basically, I couldn't get my words out. So as mentioned, there is no dividends. Lyft does not pay dividend as it remains focused on strengthening profitability, cash generation rather than provided income payouts. As you can see, at this time stage, returning cash via dividends would limit flexibility. So why does the buybacks make sense? So Lyft is still in the transition phase, moving from growth to profitability. Buybacks are flexible, can be adjusted based on cash flow conditions. Reducing share count helps offset past dilution from stock-based composition, and more efficient than dividends while the business continues to scale. So as you can see, return on capital and operating leverage. So as you can see, the ROE was actually up at 140.8% current, which is improved by the 3-year average, but that is a big jump. We'll cover that in a second. The EBITDA margin, as you can see, is on there with a free cash flow margin at 17.7%. So with a asset-light model creates operating leverage. As Bitcoin grows, costs increase more slowly than revenue. This means growth can translate into high margins, improved cash generation, leading to stronger returns over time. So we've now also done the valuation. So intrinsic value is saying that even on the worst case scenario, Lyft is so undervalued. Now the DCF value, only the worst case scenario says it's overvalued. And on the relative value, it all says undervaluation. So there could be something to look at here in terms of it saying that it's undervalued. Now, of course, it makes sense to look at EV to gross profit and free cash flow yield as well to make sure that this is all correct. But of course, do your own research when possible. So what are Wall Street estimates? I've also covered this slide, but basically it's analysts at Wall Street saying that what they're predicting the stock will be in the future. So as you can see, the lowest forecast is a -5% downside. The average is at 51% upside at $20, and the highest upside, of course, is at $32, of course. So the recent news and headlines for Lyft. Well, of course, as we already noticed, the Lyft also announced a $1 billion buyback and generated over $1 billion in free cash flow. Analysts like Goldman Sachs have maintained positive ratings through price targets and remained mixed, though, however. But the stocks also reacted strongly around earnings as investors reassess Lyft's profitability. Of course, short-term stock moves and recent share prices have reacted positively to strong working growth and revenue growth, moving around earnings releases and guidance updates. However, please do note, as I was recording this, Lyft actually announced its earnings, and the guidance actually went lower, so the stock absolutely tanked. So that is why you saw a load of red and why it was a bit minus on this month, because they lowered the guidance for this year. So that brings us on to the big news that has been going around. Is Amazon going to get Lyft? Well, there's been a long-running speculation about the potential Amazon acquisition, but there's been no confirmed deal, and Lyft is currently not actively seeking a sell. However, even if Amazon were to acquire Lyft, that would be an upside optionally, and if it doesn't actually happen, it doesn't actually change the core thesis of Lyft's value, which will still be driven by bookings, margins, and free cash flow, which will hopefully, as well, bring an upside to the stock. So what do I think Lyft is? So I actually do think Lyft is an ad looking at this. Now, there is a lot of risk. It is a growth company. It's a lot of doing to get to the right stage, like Uber and what Uber is doing. However, with the free cash flow being now growing, and I don't really see it realistically going back to the years of the cash burn. If it's now going to be the free cash flow generation of what it's showing, and with hopefully the buyback's going to be continuing, to me that would reduce the risk and improve the quality of earnings. Now, of course, don't just go and add this stock because I say an ad. I am taking opportunities. I think this could be a good opportunity for the long term, a long play. I'm not saying 2 years' time. I could be saying this in about 10 years' time that this stock could be there. But if you found this stock analysis helpful, then of course make sure to leave a like, hit the subscribe button, and follow for weekly updates. Now, if you guys enjoy, and I'll see you on the next one. Goodbye.